Hello, everyone. Hello. Welcome. I was talking to myself, unfortunately. I was muted. Hopefully, you can hear me all loud and clear as usual. Don't be confused by the title. It's not a repetition of last week's webinar. It's just I wanted to do a quick briefing because it's like a second part of last week's webinar, okay? But what we're going to cover today is price action and mean reversion, the differences, and we're going to go through some strategies on both price action and mean reversion trading as well. So don't worry, it's not like a repetition of last week's. It's a continuation of last week's webinar. So let me just, okay. Thank you for confirming, my dear, this the sound and the audio. By the way, I'm gonna add a handout. Okay, it's I have put in a single handout both slides. I mean, last week's and this week's. So in the beginning, oh, why is not that there is an error? Why is that? Let me open it again. Click. I want the. That's weird. Just give me a second to upload again the handout. I tried and apparently there is an error. Sorry, I'm gonna try again. So for those that haven't been here last week, don't worry. On the slides, on the handout that I'm gonna share right now, both webinars are on last week's and this week's. So you're gonna have the full price action, both parts of price action webinar. Okay, so I need to go through, as usual, the disclaimer warning, and we gonna start as soon as I'm done. Okay, if you need any questions, if you have any questions, interrupt me, let me know what you're struggling with, and I will try to explain everything as simple as I can. So, disclaimer. This material is provided as a general market communication for informational purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Sorry. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Trading leveraged products such as forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risk involved, take into account your investment objectives and level of experience before trading, and if necessary, seek independent investment advice. Please read the full risk disclosure on our website along with all the rest of the legal documents that we have over there. So, risk warning and risk and disclaimers out of the way, so we are good to go. I don't have any comments from you, so I assume that you managed to download the handout. So, okay, here is a reminder of our email address. Oh, let me get this step backwards. Webinars at hfm.com. Okay, feel free to ask anything you want, send me screenshots, anything you want. It doesn't necessarily need to be about the webinar topic. Okay, so here is just an email you can use in order to contact me and Stuart and our analysis team in general, and ask any questions that you have, any things that struggles you that you need help with. So that's me. I'm not going to spend time on me. I'm going to skip myself and we are good to go. Actually, we're not good to go. I need to skip the slides of last week's webinar. So I'm going to go straight to today's second part of, oops, here we are, of second part, second part of price action. So today we're going to see, once again, very, very briefly, what is price action, but mainly we're going to focus on the difference between price action and mean reversion. So we're going to see what is mean reversion as well, but I'm going to focus a bit on the strategies. Some very easy, straightforward price action strategies and some very easy, straightforward mean reversion strategies. Not precisely strategies, but okay, they are strategies, but I mean, it's pretty much how you can use some indicators for these two type of strategies. You're gonna figure out what I mean, I'm sure. So I'm gonna see, as I mentioned, this is the main topics that we're gonna cover today. Okay. So just very, very briefly, because I'm not sure how many of you were here last week as well. So I'm going to repeat what price action is, okay? Before we go through the difference with mean reversion and so on and so forth. So, okay, let me just put this at the side. Excellent. Excellent. Okay, let's do it. So once again, guys, price action. Have in mind very, very simply that price action is just a different term for the movement of an asset. So price action trading is a trading strategy, the trading strategy, in which we don't use technical analysis or fundamental analysis, but purely we use the price move. So the candlesticks, we observe the price movement. Very, very carefully observing the price movement, and we use that as our sole technical indicator. So we place our trades based on the observation of the price movement and on our individual decision making. Okay, just a very, very big note over here, cautious note, pick highlight if you prefer. Remember that you guys, all of us, okay, we don't trade billions, we don't trade millions, we're just retail investors, right? So we represent less than 10% of the market. The big boys, the big movers are banks, hedge funds, people that trade billions. So key in trading is to understand the overall movement of a trend, the overall movement of an asset. Why? Because with this way we're gonna understand where these institutional players, big players, banks, hedge funds, and people trade million how these people are trading. Okay, so with this way, we're gonna figure out which side we should take. There are many short-term traders that rely exclusively on price action in order to make trading decisions. Okay, remember that the technical analysis, I mean using indicators, you remember the indicators are just derivatives of price actions because they use past prices in calculations. So by observing price action, by interpreting what the price action is signaling, okay, is another form of technical analysis, but solely using the price action as such and not using any indicator. The only thing that you need is to figure out the overall trend, the overall direction, because remember, with this way you are on the side of the big institutional players, etc. And also, if you are intraday trader, I mean trading in the intraday basis and etc., you need, or regardless of what trader you are, I mean intraday or long-term one or short-term one, medium-term one, etc., the next thing that you will need are support and resistance levels after you closely observe and carefully observe your candlesticks. So I'm keep saying candlesticks and candlesticks and candlesticks because this is preferably the type of charts that will help you the most. Candlesticks will help you to visualize better the price movement by displaying the high, low, close, open values in the context of an up or down days. And also it will help you to identify candlestick patterns as well, such as harami, co-leafing patterns, and etc. So once again, I remind you that price action, and I'm saying remind you because some people have been here last week as well, so they have seen the slides. So I remind you that price action trading, okay, is very, very common to retail and institutional traders. Is less popular due to the high frequency trading and due to the rise of algorithmic trading, but it's widely used, especially from day traders, because the day traders tend to place very large trades, often with the use of leverage, using price action as their only guide, with the aim to generate profit from very small underlying movements. Okay, so technical and fundamental analysis are not especially useful if only in the cases in which actually, okay, let me rephrase that. Technical and fundamental analysis aren't especially useful in these cases. I mean, in the cases in which you're aiming to profit from very small underlying movements. So given the very short nature of the price movements, price action can provide some helpful clues into supply and demand balances. So price action, just stick on what I'm just saying right now. Price action trading involves placing trades exclusively based on the price action rather than fundamental or technical analysis. So it solely involves placing trades on the identification of a trade condition and our also decision to buy, sell, or hold an asset, because this is subjective as well. So I'm not gonna go through. I'm not gonna continue with what price action is and etc. because I want to go straight into price action strategies. Okay, but what I'm gonna say just on the very last bit of our my intro about price action is that you need to think, you need to have always at the back of your head that price action, so solely the investigation, the observance of the candlesticks purely without any indicators, aims to speculate and predict prices, okay? And it's used by all of the market participants, either retailers, either big players, and etc. In every single, so it can be used in every single asset class, in every single time frame. So don't ask me about time frames because it can be used everywhere. Okay, because after all, it's only the observation of candlesticks, no technical indicators, nothing. The only reason that I have put Bollinger's over here is just to be easier for you to understand that this is an uptrend, this is a downtrend. But because we don't use any technical indicators, it's just the observation of the candles. It can be applied for every single asset class, for every single time frame. But what it's essential for you to understand is that if you are the type of trader that trades a minute, stick on it. Trade a minute using solely price action. So by solely observe your price action, your candlesticks, but don't change time frame before in order to take a decision. No. If you're a 1 minute trader, observe your own 1 minute chart and take decision based on your 1 minute chart and set your targets and stop loss based on the 1 minute chart. Don't switch time frames. This is the only case that you will hear me saying don't change time frame. Is the only time that you're gonna hear me saying something like that, because price action is very clear. It's the approach to speculate and predict prices for a particular asset, for a particular time frame, and this is what you need to focus on. Don't switch charts. Okay? Take your decision based on what you see, not what you think. So, one more thing. What are price action signals? Actually, no. Let me clarify a bit. What is the difference between price action, indicators, and technical analysis? So what is the difference? As we said, price action is the activity of our price, so observing the price, the candlesticks solely, and any sign that the candles are giving us, okay, will help us to identify and to take a trade. So based on the observation of the open price, low, high, close price, the body of the candles, whether they have an up leg, a down leg, and etc. Technical analysis, however, uses a range of different calculations to predict future price movements. So by contrast, price action relies only on the price movement of the asset within a particular trading time frame, while the technical analysis uses different different ranges of the future price. Remember, RSI, for example, 14 RSI, so uses the 14 previous periods in order to give us a signal. But the price action is different. Price action relies only on the price movement of the asset at a particular trading time frame, not on the previous 14, 16, 17, 20, and etc. So in a way, technical analysis is attempting to find order within this within trading, while price action allows a trader, you guys, to take a more traditional gut-based trading approach by spotting price action indicators and acting on them. So now, oops, sorry, skip some slides. Let me just, okay, here we are. So just few points on why is price action important, popular among the traders, either forex traders, either bond traders, either stocks traders, etc. So why? First of all, by the way, it's not something that it can be used only for experienced trader. Thankfully, price action trading it can be used to newbies, beginners, because it's easier to be understood. It is easier to be used, so a lot of beginners are using price action as well. So price action trade is easier to use for short to medium term limited profit trades, at least for the beginners, but also to long term traders, okay, as well. We have mentioned the difference between technical analysis and price action, but and we went through last webinar some approaches using the price action, but in this case, and today, come on, we're gonna go through, some actual examples, some actual strategies, okay? Are you okay so far, guys? I haven't confused you, was a bit boring, I said a lot of theoretical stuff. Are you okay so far? Oh, here in Cyprus is so hot over here. Okay, so I haven't got any reply. I assume everything is okay. So I'm gonna go through and quickly go through my 7 trading strategies. Very straightforward. It's just to remind you of some patterns that are actually price action strategies. We have seen them in the past separately, but they are actually very useful price action trading strategies. So these are the seven. I have put 7 in an order, okay? price action trend trading, pin bar, inside bar, trend following retracement entry, trend following breakout entry, head and shoulder, sequence of highs and lows. What? Let's go through together what we mean by that. The very first that I mentioned, right? It was the okay, it was the price action trend trading. Okay, let's leave that from now. I went through that last week. Price action trend trading. What we mean by that? Let's take a step backwards. And this is the very last example of last week. So what we mean by that is when we study our asset, okay, and okay, there are obviously a number of trading techniques in order to spot and follow price action trends. But a nice way to start is to highlight, put a note on any swings that you see. Okay, so in this screenshot, for example, you can see some rebounds at support levels or pullbacks at resistance levels. So rebounds, can you see that? Rebounds at support levels, reversal at retracement levels. So some relative highs and relative lows. So these guys, pretty simple. These kind of stuff, these relative highs or relative lows could be used as buying position or sell position. So let me check whether I have something. So here as well. So this relative high, okay, or this another relative high over here in a downtrend, or this, which is another relative high in a downtrend. This can be used as selling positions. If you are in a downtrend, if you have identified downtrend, if you have identified a uptrend, let me see whether I have something over here. Okay, this. Okay, let's just focus on that one. In an uptrend, if you have identified relative lows higher and higher and higher and higher, these are buying positions. Okay, simple as that. So if you know that you are in an overall, you have identified that you are in an overall uptrend and you have saw some swings, some relative lows, some correction, that's a buying position. If you're in a downtrend, you have spotted some relative highs, lower and lower, some pullbacks, that's selling position. Simple as that. This is what I mean by saying, let me just, by saying price action trend trading. Now, pin bar. Okay, that's nothing new. It's just if you're a person that doesn't use candlesticks, but you're using pin bars, okay? Actually by that. So what we mean by pin bar is when we have, let me put my, I'm gonna put my charts on. So what we have over here, if you have identified, actually my mistake that I didn't put a line, then put a picture or something, but pin bar, come on, let me see whether I can find one. Yeah, I'm gonna copy it from Google just because I want you to understand what I'm saying. Okay, so here I just put this on. This is what we mean pin bar. If you have identified on your chart this kind of candles, which are called pin bar, why they are called like that? Because they have a small body or no body, okay, no real body, but a long tails. So something like that, okay, with long wing, either up wing or lower wing, okay, not both a long wing down wing or a long like that. I mean, let me draw it. These are the pin bars that you need to have, but not a pin. Oh my God, my drawing is awful. Yeah. I'm not referring to this kind of pin bars. These are the pin bars in which we have either only a down leg or either only an up leg, not both, because both means indecision. Okay, so I'm referring only to this. So if you have identified on your trends, on your charts, this kind of shapes, what it usually presents is a sharp reversal, and a rejection of a particular price. So if we are in, let me bring my charts on. If we are in a downtrend like this one, okay? Here we are, okay? Let's just focus on this, And we have seen this latest candle, right? Which is a pin bar with nose, right? It's a pin bar with no real body and wick at the top. So this is a this represents a sharp reversal and a rejection of the particular price. So in this case, it was a rejection of the 103 level, 103.30. So signals a reversal. Okay, so the assumption over here is that the price will continue to move in the opposite direction to the tail. So our tail was up, so that means that it was a bearish signal that the price will continue to move on the opposite direction of this tail, so down. Is this clear? And this is what indeed happened, as you can see. So using pin bars means that if you have identified something like that, it means that the price in the next few sessions will go on the opposite direction of the tail. So if the tail is down, the price could go up. If the tail is up, the price could go down. Is that clear? I think it is. So let's move on. I mentioned inside bar. What I mean by that? Inside bar, we'll show you exactly what is. Sorry. Let me clear a bit all this mess. Okay, so I need to illustrate it actually because it will be clearer. Okay, I will use my chart again, my platform. So first of all, okay, before I show you an example, but have in mind that this side bar is when we have two candles, okay, in which the insider bar is smaller and within the high to low range of the prior bar. So what we mean? When the high is lower than the previous candlestick's high, and the lower is higher than the previous bar low. Let me show you exactly what I mean. I'm going to copy a screenshot once again. I took this for granted and I didn't put screenshots, but I shouldn't. That's my bad. Okay. Okay, let me erase all this. Okay, here we are. So by inside bar, we are referring to this kind of formation. If we have two consecutive candles, okay, in which the 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 low, the second in the second candle, the low was higher than the previous low, and the high was lower than the previous low, previous high. Sorry, you see, lower high, higher low. Okay, that means, or that signals, okay, signals first of all that we have some kind of a consolidation, as you can see, okay, but this consolidation can also act as a signal of a turning point, okay. So so the next candle, the very next one, will clarify, will clear the direction of the trend, and here is when we can take action. Okay, so let me show you an example as well, just to be clearer for you guys. It doesn't necessarily mean, by the way, that they are small body candles. They might be big body candles. What matters is to have higher low and lower high. The second one to have lower high and higher low than the previous. So let me see whether I can find one on the dollar index, for example. Just very, very, very quick. It's not very easy, but I will do my best. Let me check. Come on. Actually, we did have one over here. Yeah, we did have one over here. You see that? Yeah. So, okay, let's focus over here. Let me zoom in. We get rid of that. Oh, I lost it. But okay, it's here. You see? Lower, oops. Lower high, higher low. So we have this inside bars, okay. So on the next candle, okay, it's not a brilliant example, but it is what it is. So we had the inside two bars, okay. So that implies it tends to imply into usually to continuation of the trend. But as I said, the next candle matters. So what happened? We had a breakdown. Okay. Okay, but okay. So have you seen that? So usually, not usually, actually, what the inside bars suggest is the continuation of an overall trend. What is the overall trend over here? Can anyone reply to me? What is the overall trend over here? Ignore what happened afterwards. So we are here, okay? And we are observing. Come on, okay. We have seen that we have two inside bars over here. What is our overall trend? Come on, come on, come on. It's not the best example, I know, but anyone? Bear. Cool. Yes, everyone spotted. Well spotted, everyone. So, so we had an inside. So we had to identify this inside bar in a down market, in a downtrend. So that means the continuation of the downtrend. So we need to be patient to see what will happen. So we can use this as our very, very first sign to put a support line at the low level of these two inside bars as our immediate support level. And as soon as this is break, then we that could be our entry point, because this is a bearish signal because we are in an existing downtrend. So this suggests that we might see the continuation of the downtrend. We had a bit of a bounce, but eventually came down and extend. Come on, and extend losses. Okay, I know this is not the best example that I could get. Actually, I'm gonna the most, in order to identify a very powerful inside bars, it will be better. Okay, let me just, because it's a continuation pattern. Okay, and do I have, let me see whether I can find, because it's in a continuation pattern. If it follows by a bearish candle, then it's a more powerful entry than this one. Okay, so if you want to ignore this example, yes, fair enough. Let me try and find another one, a more useful one for you guys. Come on. No, I'm not lucky enough. Okay, I will get back to this example. Okay, but a better, a more powerful signal is if you have a presetting trend, and if the next candle is confirming the continuation of the previous trend, the presetting trend. If it's on the other side, then this is not a so powerful signal. Okay, so if this has been spotted in an uptrend, and the next candle after these two insiders is bullish, like this one breaking the previous top as well, then this is a power signal because it suggests the continuation of the uptrend. Okay, so it's better to use these inside bars only if you have if your next candle after the inside bars, it's on the same direction as the preceding trend. Okay, now let's move on. What do we have over here? So I did mention, I'm going very briefly with the strategies because I have more these are quite straightforward. So trend following retracement entry and trend following breakout entry. Very simple. What I mean by that, or we mean by that, here it is. Okay, obviously we are in an uptrend. It's very straightforward, right? So by connecting the highs, right, here we are. What we have over here, if we are in an overall uptrend, but okay, this is a very simple price action trading. We just simply follow the trend. So even if you have identified a clear downtrend, like this one, pullbacks downturn with lower highs being consistently created, like here, okay, like here. So you might either want to take a short position, temporarily one, only in the very short term, or once your asset start trending higher again, remain on the side of the trend, take a long position based on the overall long term and based on the buying the dip, if you prefer, opportunity over here. Okay, this is what we mean trend following retracement entry. Now, what we mean by trend following breakout entry. So if we have, again, let me just clear, an overall uptrend, right? We have seen connected the lows. The previous high was here. Okay, here we are. That's a clear uptrend. The next resistance is over here. Okay, brilliantly. So as soon as we see a breakout, so an extension of our uptrend, along with a breakout of the previous retracement level, that signals the continuation of the trend, so we can enter long based on the fact that the stock is trending upwards above our resistance line, so more buying trades could be added on this breakout. Okay, easy peasy. Now, head and shoulder reversal, or a sequence of highs and lows. I'm gonna show exactly right now, not only head and shoulders, but also some other scalping strategies. Okay. Remember, candlestick patterns can be very useful for identifying entry. Is head and shoulders, is cup and candle, is a lot of continuation, a lot of candlestick patterns that are useful as price action strategies. Okay, I'm not gonna go through the head and shoulders, but I'm gonna go through the hamari, which is the hamari, the shooting star formation, other patterns, because head and shoulders is very popular. So I would like to go through these, which are still very popular, but I'm not sure whether everyone knows them. You should, but okay, just a reminder. So hammer, if we have identified a hammer pattern. So what is a hammer? Is when we have a candle, okay, that signifies, first of all, a hammer is a bullish signal. That signifies a higher probability of the market moving higher than lower. Okay, it's a bullish sign. A hammer looks like a candle that it has a long down leg and a bullish body. Okay, so like in this example over here, okay, a longer down leg than the upper one and a bullish body. A long leg and a slightly bullish body. That's a bit dodgy, but yeah, it's still a hammer. So if you have identified a candle that has a long down leg and a bullish body, and it has also a tiny up leg or no up leg, that's a bullish signal, because it shows that the sellers are pushing the price to a new low, but the sellers weren't strong enough to stay at the low, and choose to bail on their position. So that means that buyers are in control. That's why it's a bullish signal. Traditionally, the close can't be below the open, but it is a stronger signal if the close is above the open price. Okay, so if you spot something like that, that's a bullish candle. That's a bullish signal. Okay, so like in this example over here, that's it's a weekly euro dollar. So once you identify a hammer, and a possible entry could be, let me take my, so identify a hammer, a possible entry could be on the next candle over here. Okay, so if I zoom in, let me zoom in a bit here. So the next day, our entry could be on the breakout of our hammer's high level. Oh, awful line, but it's supposed to be a trend line. So on the breakout of our hammer's top level, so that could be our entry level. Okay, with stop loss, the stop loss, it could be the low of the hammer. Okay, and target, there are multiple ways to add your target. So it could be twice the distance from the low. So if we measure the entry and the low, the stop loss, and it has 20 pips for example, 20 pips, 20 pips away, 20 pips away from our entry, then you can set your target twice, so at 40 pips away. There are a lot of ways to do that. Or you can put a trailing stop. If your trade is in profit, you can identify, you can set a trailing stop, or targeting the levels of support or resistance, or using trailing stop losses, and etc. Okay, there are a lot of ways to do that. We have mentioned several times, and we had the webinars exclusively on where you should put your stop loss, where you should put your target, and etc. on alternative ways. I'm not going to go through that right now. Over here as well, you see a hammer, the next day bullish, strongly bullish, breaking my upper high. So that could be an entry point with stop loss over here at the previous low, and target could be at the previous resistance, so over here, and indeed it targeted right on this resistance over here. So I'm not going to spend time on the target level, because there is multiple ways to do that. Depends on what kind of strategies you have, what kind of profit what you're targeting, or kind of price management of risk management you're having, and money management you're having, etc. Okay. Another example, shooting star formation. If you identify shooting star formation, what's a shooting star formation? Shooting star formation is a bearish signal. So if we have a long up tail with a doji body, or a long up tail with no down tail, okay, this is a bearish signal. So if we have a shooting star, that's a bearish signal. So as soon as you see a breakdown of the low of this shooting star, you can enter short. You see, it should work most of the time. Sometimes it doesn't. But since if you had set your stop loss at the appropriate level, you would have broke even, like in this case over here, because it was a false alert. If the stop loss was here, okay, above the top leg, then we should probably break even or have some tiny losses. So once again, if you have identified shooting star, which is a bearish signal, entry could be taken as in the next day, as soon as the asset breaks the low level of our shooting star, and stop loss to be set at the high level of our shooting star, and target either at the previous support levels or based on your risk and reward ratio, or targeting previous support and resistance levels, or using trailing stops, and etc. Okay, crystal clear? Let's move on. Let me zoom out. Harami. Don't know how many of you know Harami, okay? But Harami is another candle, not another candle, actually it's another candlestick pattern, but combines two candles. So it looks like that. A bullish Harami looks like that, and a bearish Harami looks like that. It looks like inside bars, but the difference is that every single, Emmanuel, as I said in the beginning, every strategy that we are going through today implies to every single time frame, every single asset. But what kind of trader you are? Which is your favorite time frame? Reply to me, Emmanuel. Which is your favorite time frame? Which is the time frame that you are trading? Excellent. So, okay, Emmanuel didn't reply, but Amanze reply, Jason reply, Jaime reply, etc. So, Amanze, you're trading a 15 minutes chart. If you identify in your 15 minutes chart a Harami, a bullish one, that's a bullish signal. So for a long position. If you identify in your 15-minute chart a bearish Harami, that's a bearish position. So guys, Jason, for example, is a 1 hour trader. Jaimech is a 4-hour trader. Stick to the time frame that you tend to trade. And if you identify one that you're trading, set a position, but don't change time frame. If you have spotted a Harami, for example, or a shooting star, or an inside bar, or a whatever, a hammer in a 4-hour chart, because you are a 4-hour trader, my dear Jaime, don't know whether I'm pronouncing your names correctly, guys. If you have spotted it over there, take your trade over there. Don't switch. Okay, set your stop loss on the time, set your target, your entry, your stop loss at the time frame you are usually trading, and at the time frame that you have spotted that candlestick pattern. Is it clear? So I'm getting back to the harami. So what's harami? Harami is a candlestick formation again, but combining combine two bars. So it's like an insider. Oh no, actually, it is an inside bar formation. So yeah, it's an inside bar formation. Can you see that? So lower high, higher low. So it's a bearish harami. Lower high. But wait, okay, here we had been in a uptrend. If we have spotted an inside bars, lower high, higher low, so that's a bearish signal. If we are in a downtrend and we identify a harami, okay, and a lower high, that might confuse you a bit. Okay, yes, I will clarify. Don't worry. So, okay, let's take it step by step because I don't want to confuse you with the inside bed bar, which implies to continuation pattern. So, a bearish harami, okay, is formed with this way. So, we are in an uptrend, okay, and we spot this harami, so lower high, higher low. So that that is a bearish signal if, only if, yeah, Amanse, yeah, I know there are traders that they don't use harami, but I have, as a market analyst, I have to present everything. And it's on your discretion to use the ones that make sense to you. You don't necessarily need to know everything. You don't need to use everything. But I am obliged to educate you. So if you spot a harami, brilliant, you can trade on it. If you don't remember what is a harami and you haven't spotted it, etc., don't worry. Don't worry. Trade what you see only. If I say that, oh, guys, I have spotted the harami on euro dollar, you don't, and you cannot see it, then you don't have to trade it. Okay, trade what you see. So I'm just presenting stuff in order to educate you, but at the end, you're gonna trade what you see. I'm just giving you more tools in order to empower your trading skills. We are not perfect. We cannot remember everything. We cannot remember every single candlestick pattern, every single, I don't know, technical or fundamental or price action analysis that there is out there, every single strategy. We are not computers. We're human beings, okay? So I'm just going through in order to educate you guys. If you remember, if you have spotted harami, why not trade it? If not, there will be plenty of other opportunities. There are plenty of other entry points that you might find. Okay, so if you have spotted a bearish harami like this one, but you didn't spot a breakdown up, which will signal the continuation of the trend, then this will be, if the next candle is not a bullish breaking the high over here, then that will, I mean, if there is not a bullish one breaking the high of the harami, suggesting the continuation of the trend, but instead you had either a doji or a reversal one, then that will be a bearish harami representing indecision, which could lead to a breakdown to the downside. So we might consolidate a bit or immediate breakdown, suggesting the reversal of the trend. Now, if you have seen you're in a downtrend, spotted the harami, but the next candle wasn't a bearish one again, but instead it was either a doji or a bullish one, then that would be a bullish signal for a reversal to the upside for the asset. And this is an example. We have been in a down, we have gap down, spotted a harami. Okay, remember, lower highs, higher lows is a harami. Is this a bullish one? Is this a bearish one? It is a bullish one because the very next one broke higher, so it's a bullish harami. So we can enter long with stop loss at the bottom of our harami and target, well, either using Fibonacci extension, either using our previous highs, either using a risk and reward ratio. So if this is 10 pips, for example, we can set our target at 20 pips away or 30 pips away, etc., and so on and so forth. Now, another bullish harami over here, another bullish harami over here. So we have over here bullish harami because on the next candle it was bullish but failed to break the previous high. So the confirmation came here. So that could be our entry point. Over here, we had been in a downtrend. We spotted the harami, but we were waiting to see whether it will continue down or whether it will signal a reversal. So what happened is that the next candle suggested indecision because it didn't break higher but remained below the high of the harami. But eventually the second one broke higher, okay, topping here. So that was a sign or an entry for a bullish position, long position, with stop loss at our bottom of our harami. You see, despite the consolidation over here, we didn't, our position didn't close because stop loss is far away still. So, and it came up here before turning back down. And you see, as soon as our target is on profit, so over here it was on profit, right? We could either shift our stop loss higher over here or use a trailing stop, and so on and so forth. A bearish harami over here. Why? Because the next candle was a bearish, breaking or retesting the bottom of the harami. Okay, over here as well. The next candle broke the bottom of our harami. So it was a bearish harami for a long position, short position, sorry, with targets either the previous support area. So in this case is this one. I cannot do straight lines, sorry. And stop loss at the top of the haramis. Crystal clear? So let's move on. That's another harami example. So I'm not going to go through it, and you're going to see it on your free time. This is another just to give you ideas, okay? It's another strategy in a 4-hour chart, okay? It's an example. There are very variety of price action scalping strategies available out there for intraday traders, either using candlestick patterns or not using candlestick patterns, or using trend lines and etc. Over here, I have put on an example. You can test it in a demo account to see whether it satisfies your strategy or not. Okay, it's just an example in a 4-hour chart. So a combination of moving averages with candlestick patterns, okay, where an entry could be taken, where the stop loss should be placed, and where the target should be placed, etc. Have a look at it. It's just another intraday strategy, okay, which combines price action with moving average as well in order to help us identify our entry levels. Okay, remember scalpers. So this is scalping strategy, to be more precise. A scalper, remember, is looking for short-term moves. Faster moving averages such as the 20 period one and 50 period ones are commonly used, with combination with hammer, harami, shooting star, bear, or hammer, bearish hammer. So harami, sorry, creates this scalping, price action scalping strategy for creates these rules for this 4-hour scalping strategy, which is combination of moving averages and price action. That's just for you to, but test it on your demo. Okay, it needs to satisfy your way of trading. Okay, it's just to give you ideas. Okay, so this I have demonstrated this in a daily in a 4-hour charts, just to make you understand how this scalping price action trade setup works. Okay, so what we have over here is, first of all, on the top we have a daily Aussie dollar. So I have the 20, the 50 day moving average, okay, and I am in an uptrend, obviously. Okay, I mean, it's easy to identify a trend. I want to believe that you are okay on identifying a trend. So what we have over here is an Aussie dollar to the upside, move higher in a daily chart, right? A long trend from March until June 2020. It's a past example, but I'm just, so I have my moving average on, etc. And it's an uptrend. In my 4-hour chart though, okay, I saw that some people are trading a 4-hour chart. So in my 4-hour chart, I have spotted, what is this? Can anyone tell me? What is this? The very first highlight, or even the second one, doesn't matter. What is this? What formations are these? Yeah. Thank you very much for your reply, Alavi. Thank you very much. So we know from we are in an overall uptrend, right? In our 4-hour chart, we had identified, so let me get a harami. So let me take a step backwards. We are in a 4-hour chart, right? We have applied moving averages, right? 20 and 50. So our moving averages, so the 20 is moving above the 50, right? So that means that we are in this long-term setup. So that's checked. 4 hour, 20 above 50, checked. Harami or hammer, checked, because we have a spotted over here. Oops, come on. Harami, right? Let me zoom in. So the 20 is above the 50. We are an overlap trend. We are in a 4-hour chart, and we have spotted a harami, a bullish harami. Actually, a harami. We cannot really tell whether it's bullish or bearish yet. So that means part of our price action scalping strategy setup that I have shown you before. So the next steps are to identify whether it's a bullish or a bearish harami. So we wait for the next day. The next day, as you can see over here, it broke, retested and broke, but closed below it, but broke the high of my harami. So that's a bullish harami. If you weren't sure whether you're going to trade that one, whether you're going to trade bullish or not, you can wait the next candle. The next candle close above my harami. So that was a confirmation of a bullish harami. So in this chart, okay, we have confirmed three things. We're in a 4-hour, in an overall uptrend with 20 period above 50 period with a bullish harami checked, right? Price action pattern is being formed in between 20 and 50 and 50 day 50 period moving average, because we are in a 4-hour chart. So indeed the harami, the price action, was within our moving averages, right? So fourth condition was met as well. So we are good to go long. Entry 1 pip above candle high. What that's supposed to mean? Let me zoom in again. So we are good to go long. Come on. Yeah, so as soon as our harami high, which is our latest high, breaks, we can go long, we can enter long, even a pip above this latest high. So you can set your pending order a pip above the high of the harami. We stop loss at the bottom of the harami. And can you see that? Oops. A pip below candle low. If I say candle low, we are referring to the harami. So a pip below the harami low or the hammer low, if you have to identify a hammer. Target either being set at the previous swing high or pip risk. What do we mean? If you have a risk and reward ratio 1 to 2, so what that means, if you're risking, your stop loss is over here, right? And you have measured your entry from your stop losses and is at 20 or 10 pips away, then you can set your target twice your risk. So 20 pips above or 3 times above. Depends on your risk and reward. Or you can simply use the previous resistance as your entry. So either this one or this one could be our target levels. Is it clear? You see? If cancel the order if not triggered by the start of the new candle. Okay? If it doesn't continue, close it as soon as, if you don't see it continue, I mean, you see, I took my entry, but the next candle turned down. It didn't hit my stop loss, but it turned down. So it's better to close, to cancel the order at break-even level or cancel it if it didn't trigger. So if you had added a pending order, cancel your order if it's not triggered by the start of the new candle. Okay, the same stands for the short-term setup. I need to quickly run to the mean reversion because we are already half an hour, 20 minutes above the hour, the top of the hour. So what is a mean reversion, guys? It's very, very simple. We're referring to the condition in which the prices, our asset, is moving sideways. But we can still trade sideways movements. We can still trade an asset that is moving in one direction. I mean, it's moving sideways at this price which is ranging. So mean reverting market is also called a ranging market, and it is it is a quiet market with little news. Okay, so if we are aware of Bollinger Bands, right, then if we see a very narrow flattened Bollinger, that implies to a ranging market, to a sideways move. But this is a condition that we can still trade. Okay, I'm giving you ideas right now. Mean reversion is theorizes that price is in a ranging market, sideways movement, but this means that the asset, because it's in a ranging market, it tends to return to the average price, to the mid level, every time that it hits its top line or its bottom line. Okay. In all cases, they are betting that extreme levels, whether it to be volatile price, growth, or technical indicators, will return to the average. This is what the theory says. What are the mean reversion strategies? The mean reversion, in theory, as we said, is the market condition in which our asset is moving sideways, but it still can be a part of an overall trading strategy. So it applies well to the ideas of buying the low or selling the high by hoping to identify an abnormal activity that will theoretically revert to the normal pattern. So if we are so what it means that we can buy the bottom or sell the high on the belief that it will return to its average line. Okay. Yes, so what we have over here, actually, oh no, let's start with this example over here. Sorry, I'm running out of steam. So what do we have over here? Here is an example of mean reversion. As you can see, it's purely price action. We have only candlesticks on and only one simple moving average. Okay, that's the 20. In this case, it's the 20 because we are in a daily chart, so we have the 20 day moving average. We occasionally see that the price accelerates above the moving average. There are some times in which we can see that the price is decelerating below the moving average, and in some other cases we are seeing that the price is moving sideways or retest several times the moving average. So this is where when we have ranging market, sideways movement. right? Now, so at the time at which the price accelerates away from the mean, so in this case, we use as a mean, as an average level, our simple moving average. So at the occasions where the price accelerates continuously away from the mean, which from the simple moving average, that's a long position. At the time which the asset decelerates from the mean, that's a short position. Okay, simple as that. I think that's crystal clear. I'm going to have another example over here, which is even more clear. I might give you some inspiration as well, because over here I have two assets, euro dollar and cable, and pound dollar. Euro dollar and pound dollar are two very highly correlated assets, right? Because they are both dollar class assets, right? So they tend to move together. So if I plot it together, you can see that they tend to move at the same direction. So if euro goes down, also pound goes down. If euro goes up, also pound goes up. So you see, they are moving on the same direction. But we have observed over here that they started moving on a different direction, an opposite direction. So that's an opportunity. Okay? When these kind of assets that they are very highly correlated, such as euro, dollar, and cable, if we observe that they differentiate, we observe that they deviate from one to the other, this creates a potential mean reversion trade, sometimes referred as a statistical arbitrage. So if euro dollar and pound dollar, so most of the time, very often they move on the same direction. If we identify the opposite scenario, so to move on the opposite direction, so in this example, cable was moving up, but euro was moving down. So cable was rising, but euro was falling. Then this means that eventually in the future they will start moving on the same direction again. So we can trade on the expectation that they will move in the future on the same direction again. Okay, so a trader could potentially buy the underperforming pair and short the stronger pair. So in this case, short the cable and buy the euro on the expectation that they will eventually align again. This creates an opportunity to profit once the pairs start aligning again. So this strategy implies if we see these such as high correlated assets to deviate, to be in a different direction. So we are selling the one and we are buying the other at the same time on the expectation that they will align again. Okay. If for any case the two assets do not align again, a stop loss can be used to control the potential loss. stop loss should be used every time that you're taking an entry. So even if eventually something changes, they don't align, anyway, your stop loss will be triggered. The profit potential, if the assets move back towards each other, should be more than enough to offset transaction cost. Otherwise, the trade may be ignored. Please be careful because a tiny divergence between correlated assets are often not considered to be worth trading. You need to see a substantial divergence like this one. Like, okay, that you see, we didn't spotted a divergence from the beginning. We were waiting to see confirmation, and it was widening and widening. This is when we decided to take the entry. So you need to be a bit patient. An intraday mean reversion trading strategy now. That's a 1 minute one. So we have our candlesticks, obviously, and a single moving average. Okay. So, okay, I'm not gonna tell you which moving average you're gonna use. It depends on the asset. In this case, the 20 simple moving average worked just fine for my asset, but you need to find the one that gives you nice signals. If you are in a 1 minute and the 20 is far away, so for example, I don't know, let me put the 20 over here. 20, simple, okay, 1 minute chart. Okay, it's not bad. Let me put the 10. Consolidates along. No, 20 looked better because 20 gives me nice retest levels and breakdowns that I could trade, so supports the asset quite well. So you need to test it a bit. So nevertheless, over here, it's 1 minute chart. It's an intraday mean reversion strategy. It only works if you have a very strong trend. So in this case, I have a very strong downtrend, okay? Make sure that you have a strong trend. If not, don't use this strategy. This strategy works only if you have a strong trend. So that's 1 minute strategy. Once you have a strong trend, in this case it's a downtrend, and it's combining the moving average along with the price action. So if we have a strong turn, this is a downtrend, every time that we've seen a reversal away from our moving average or a return below our moving average, like in this case, then this is this could trigger our attention for a short position. Okay? Okay? You can tell me, but this failed. That's fine. It will kick your stop loss, or you can break even. Doesn't necessarily needs to work every single time, but look at that. 4 times out of 5, it works just fine. Okay. If we are in an uptrend right now, every time that rebounds, okay, more precisely, rebounds above our moving average, like in this case, not this one. This wasn't a strong case because it was still trading below my moving average. This is a nice long position because it rebounded, it tested my moving average and rebounded away from it. It could help us gaining some few pips more. If we don't have a strong trend at present, don't take the entry. Okay. Last but not least, guys, because I need to call it a date, you can another intraday strategy, okay, that you can use. This is 1 minute again, but okay, you can test it in other time frames and you can adjust it on your time frame. is a combination of my price action with my 20-day moving average or 20-period moving average and MACD. So what we need to do in this case, if we have identified that MACD is presenting some consecutive resistance levels like this one, okay, we can put a line on our MACD and a line also on some consecutive lows. That's one thing. So we have set our MACD, we have set our resistance line on the MACD, our support line on the MACD line, okay? We have our moving average as well. So what we need to observe, sorry. So the black line over here in the MACD marks the common areas where the MACD struggles, the resistance area of MACD, the areas in which it tends to revert back down, while the bottom black trend line is when the MACD reverts again, but to the upside. Okay. So how could this strategy be useful? It could be useful because you may enter a short position if the price rises above the bottom line of the MACD with a um, sorry, you can you may consider a short position if the price rises above above the MACD's reversal level, but confirms also a drop. So if we see the MACD breaking our reversal level and then turning back down again, that's a short position. So an up, a breakout, and then a reversal down, a breakout, and then a reversal down, a breakdown or a retest, and then a reversal down. That's a short position. Now, on the flip side, if we have a breakdown and then a reversal back up, that's a long position. Okay? Simple as that. Guys, sorry, I need to call it a date. I have put one more slide on for you. It's some useful information in regards to different time zones, on which time zones this strategy could be applied. Because you know, Japan and Asia markets tends to be a more quiet sessions or mixed session. London and Europe one has some characteristics. For example, 60% of the total volume of transaction inside the day happens during London Open. So a lot of price movement occurs during London Open. So you might consider, so that's why this kind of price action traders could be applied best during London Open because we have a lot of volatility. But also in the European Open as well. Okay, so just some very basic information. You can go through it, study it on your free time, come back to me with questions, but I'm gonna call it a day right now because we are so over that hour, 40 minutes past the hour, so I'm gonna call it a day. You are tired as well, I'm tired as well, so it doesn't worth to keep going. Anyway, email me at webinars@hfm.com with any questions, any questions. Go through the recording as well. If you need any help from me, I'm here to help anyway. I'm gonna call it a date. Thank you very much for being here. Thank you very much for attending. Hope you have it. You found it useful. If not, let me know. I really need your feedback. Okay, really need your feedback. Come back to me with suggestions, with things that you want to see, with things that you want me to cover, and etc. Email me at webinars@hfm.com. Thank you very much. Hope you are having a great day ahead. I'm gonna call it a date. And take care, because tomorrow is the Fed. A lot of volatility is expected still. It's a massive week. So stop loss, risk management. Don't forget that, regardless of what kind of trader you are, and regardless of what kind of time frame you're trading, risk management, money management, first of all. Thank you. Have a great day ahead. See you again tomorrow. Bye bye.